Welcome! We're about to build your professional toolkit for analyzing equity securities. This is the kind of stuff that's not just crucial for your exams, but it's what you'll be using day in and day out in your finance career. So let's get you equipped.
Okay, let's kick things off with something a little different. Preferred shares. They're often called a hybrid security, and for good reason. Just think of them as sitting at a crossroads between a stock and a bond. On one hand, you get ownership in the company. That's the equity part. But on the other hand, you get a fixed dividend, which feels an awful lot like a steady interest payment from a bond.
Now here's where it gets really interesting, and it's a detail you absolutely need to know. It's all about what happens if the company has a tough quarter and has to skip a dividend payment. With cumulative shares, that missed payment doesn't just disappear. Oh no, it gets added to a tab. The company has to pay you back everything they owe before the common stockholders get a single penny. But with non-cumulative, if they skip it, it's just gone, forever. You can probably guess which one investors prefer, right? And that bond-like dividend we just talked about, well, it has a really important side effect. It makes preferred shares way less volatile than your typical common stock. And because of that stability, portfolio managers, the pros, they often don't even group these with other stocks. Nope, they slot them right into the fixed income part of a portfolio right alongside the actual bonds. Pretty interesting, huh?
So you know what kind of security you're looking at. But now for the million-dollar question. What's it actually worth? What's the right price to pay? Let's dive into the two major schools of thought on how to figure that out.
This really breaks down the two main camps. First, you've got absolute valuation. Think of this as looking inward. You're digging into the company's financials, its cash flows, its dividends, and you're trying to calculate one single specific number, its intrinsic value. The dividend discount model is a classic example you'll see on exams. Then you have relative valuation. This is all about looking outward. You're not trying to find a magical number. You're just comparing. You're asking, hey, how does this company's PE ratio look compared to all its competitors? Is it on sale, or is it overpriced compared to the rest of the industry?
And that idea of intrinsic value brings us to one of the most powerful concepts in all of investing. I'm talking about the margin of safety. It's such a simple idea, but it's absolutely fundamental. It's your buffer against being wrong.
So here's how it works. Once you've done all that work and calculated what you think a stock is really worth, you don't just go out and buy it if the market price is a few pennies less. No way. Smart investors demand a huge discount. They'll only pull the trigger when their calculated value is way higher than the price on the screen. That big gap, that's their safety cushion. It's the room for error, just in case their analysis was a little too rosy. And this is a question every analyst has to answer for themselves. Seriously, there is no textbook number. How big does your margin of safety need to be? It really boils down to how confident you are in your own work and, frankly, how much risk you're willing to take. It's the cushion that lets you sleep at night.
Okay, let's switch gears a bit. We've talked about valuing a company, but how do you even find companies to look at in the first place? Well, active managers usually fall into one of two camps, top-down or bottom-up.
This table lays it out perfectly. A top-down investor starts with the big picture. They're looking at the whole economy first. They'll say something like, you know what? The economy is booming, and it looks like the technology sector is set to grow like crazy. Okay, now let's go find the best tech stock. See? They go from big to small. A bottom-up investor does the complete opposite. They start by finding one single, fantastic company. They fall in love with the business itself and say, this company is a masterpiece. It's so well run, I don't care what the broader economy is doing. I'm buying it.
Now, for those top-down analysts, they need a map of the market, right? A way to organize everything. Well, that map is a global standard that sorts every single public company into one of just 11 sectors. That's it, just 11. This gives them a really structured way to look at the entire economic landscape and decide where they want to place their bets.
All right, so whether you start top-down or bottom-up, you eventually land on a specific company you want to investigate. So what's next? Well, it's time to put on your analyst hat and look at it through 4 very different lenses. Each one of these gives you a totally different but vital piece of the puzzle. You've got fundamental analysis, which is all about digging into the company's health to find that intrinsic value. Then there's technical analysis, which ignores all that and just studies the stock chart itself, looking for patterns. Quantitative is all about the hard data, the ratios, the numbers, and finally, qualitative, which is the story. How good is the management? How strong is the brand? A truly great analyst learns to use all 4.
And I really want to hammer this point home. There's a huge philosophical difference here, especially between fundamental and technical analysts. The fundamental analyst is basically saying, the market price is often wrong, and my job is to figure out the true price. The technical analyst says the exact opposite. They believe the current price already reflects everything. So their job isn't to value the company, it's just to predict where that price is going to move next. Two totally different games.
Last but not least, before you invest a single dollar, you have got to do a basic health check on a company. And the very first stop is a simple one. Can this company pay its bills?
And that's exactly what liquidity ratios are for. They're a set of simple calculations that answer one critical question. Does this company have enough cash, or stuff that can be turned into cash quickly, to cover all the bills that are coming due in the next year? It's basically a short-term survival check.
You can think about this in two steps. The first, broad-level check, is just looking at working capital. You take current assets and subtract current liabilities. Easy. That gives you a general idea. But if you want to be extra careful, if you want the most conservative view possible, you move on to the strictest test there is.
And that is the cash ratio. This is the ultimate acid test. It's tough because it completely ignores assets like inventory because, hey, who knows how long it'll take to sell that stuff? It looks only at pure cash and things you could sell today, and it compares that to the bills that are due soon. If this ratio is strong, you can be very confident that the company isn't facing any immediate financial trouble.